they originally wanted to be an outsourced options department. A lot of Wall Street firms were cutting those departments. The ones that were there weren't great. And they started that newsletter originally as an options newsletter. And after the 1987 crash, because so many firms had big underwater equity situations with people writing, naked puts, they had huge losses, and they didn't even want to have an options department.
Hello and welcome back to Traders of the World. I'm your host, Flávio Lemos. Before we dive in, a quick note for our audience. If you get any value from this conversation, please do us a favor. Hit that lucky button, subscribe, and leave a comment below with your biggest takeaway from today's very special interview. Trader, do you use relative strength as a weapon? For such a special occasion, I'm not alone. I'm thrilled to be joined by a fantastic co-host, Lucas Claro, a CFT. He's an investment strategist and market educator, passionate about technical analysis, price action, and trading psychology. Former head of technical analysis of BTG Pactual, he now focuses on helping traders and investors apply professional-level market research and disciplined strategy worldwide, and he's an active voice in financial media. So, say hello, Mr. Lucas. How are you doing? Happy that Vasco is a rising star?
Yeah. Very happy to be here. Thank you, Mike. Thank you, Flávio. It's going to be an honor to co-host this podcast, and very happy with Vasco going up on Brazilian Football League.
Okay. So today we are joined by a veteran portfolio manager from one of most respected names in tech analysis, Dorsey, Wright and Associates. He was a senior portfolio manager at Dorsey, Wright Money Management, a firm he joined back in 1994. He's a former board member of the Market Technician Association and the past editor of the Journal of Tech Analysis. What I find most fascinating in his unique background is that he's graduated summa cum laude with a dual degree in psychology and in English, giving him an incredible framework for understanding the human element that drives markets. He is also the author of a classic and a brilliant piece of investor psychology called 10 Ways to Sabotage Your Portfolio. So you don't need to sabotage your portfolio anymore. You have Mike here. Michael Moody, it's an absolute pleasure to have you on the show. Welcome.
Thank you.
You can't afford to miss it. Don't go anywhere.
You ever wondered what truly connects traders from Tokyo to London to New York? You just need to learn the language. That language is technical analysis. Understand its signals, and you'll understand the world. Welcome to Traders of the World. Here we skip the jargon and just figure it out together.
Let's go.
Okay, so the first question, Mike, let's start with your background. Most portfolio managers come from finance or economics or a business, but you studied psychology and English. How has that foundation in human behavior or storytelling shaped your approach to the seemingly quantitative world of market analysis?
I would say I don't think the English really had any impact, but in terms of psychology, the area that I was interested in was cognitive psychology, which is kind of a pinhead psychology. You know, it uses statistics and experiments, not so much someone on a couch. But when you look at data from that, you realize that there are all kinds of anomalies in the way that people behave. And immediately after I got out of college, I worked for a couple of years for the American Psychological Association as an editor, putting my English degree to work. And some of the papers I edited were Kahneman and Tversky's papers in what was called JPSP, the Journal of Personality and Social Psychology. I dealt mostly with actually Amos Tversky. He was sort of the contact for the papers. But at the time, they were writing about anomalies in decision-making. They had not applied any of it to finance at that point. But as, you know, eventually Kahneman won a Nobel Prize for it. But it pointed out that people make these systematic errors in decision-making. And later, when I went to work at Merrill Lynch in New York, you could see these same errors in decision-making. You were like, well, I know where this came from. You know, it's a very recognizable pattern. And then, you know, you start to look at things like the AAII sentiment data or investors' intelligence sentiment data, and you realize, gee, when everyone's bearish, things go up. When everyone's bullish, things go, yeah, okay, so this makes sense based on what I had seen in practice. And so it became a very useful tool at the beginning. And so that attracted me more toward technical analysis as opposed to fundamental analysis, because I saw a lot of the fundamentalists at Merrill making all those same cognitive errors. They loved the stock at the top. So I went back through a database, you know, to look at the ratings of a stock. They had a, you know, strong buy, hold, that sort of thing. And then you could see when you looked at a chart that where they had the strong buy was always the peak. When they had the sell on it, it was always when you should be buying it.
Everybody wants to go to a party that is already full, huh? Nobody wants to go to the party when it's empty.
But it's also a matter of incentives, right? Because the analysts at the time, and maybe it's different now, but this was, you know, 1980s. They were being paid on the volume of trades that their recommendations, you know, that was their bonus. So if they got a lot of volume, a lot of trading based on their rating changes or their reports, they made money. And they've quickly figured out how to do that is when everyone wants to buy NVIDIA, you just tell them, go buy it.
You just need to say to them what they want to hear, right?
Exactly. But of course, that turns out to be, from a contrarian point of view, not the way to handle it. So turned out to be an incredibly good background, not by my design, but just from seeing the way markets actually work and the way they're driven on emotion.
That's good background for you, for anyone. Mike, you were an early customer of Dorsey right before joining the firm. The popular story is that the firm was forged in fire of the '87 crash. But you have noted the history is more nuanced. Could you set the record straight on the firm's evolution from its early days in options to its focus on stock analysis, and specifically about the role your money management group in Pasadena played in pioneering the focus on systematic relative strength?
Yeah, I think originally, and Tom Dorsey talks about this some in his books, they originally wanted to be an outsourced options department. A lot of Wall Street firms were cutting those departments. The ones that were there weren't great. And they started that newsletter originally as an options newsletter. And after the 1987 crash, because so many firms had big underwater equity situations with people writing, naked puts, they had huge losses, and they didn't even want to have an options department. So they quickly turned it into a stock-oriented newsletter. And because of one of the people that was in their options department, a gentleman Tom gives credit to named Steve Kane, who used at the time these Chartcraft point and figure charts for his stock selections, they decided to go that route and do it. Chartcraft was an interesting organization. It's still around. It's been acquired since since those days in the 1980s and 90s. But they did use relative strength, but not in a systematic way. I'm sure some of the practitioners did. But after a number of years of managing money at Dorsey Wright, starting in 1994, we realized we were getting much, much better results overall from stocks that were on relative strength buy signals than on stocks that were on relative strength sell signals, even if they were temporarily strong. And so we started to make it into a more systematic way of looking at those charts to make our equity selections, and that really paid off in a big way.
So you have mentioned that your own performance attribution data showed that about 50% of the returns came from using relative strength, with sector and stock selection making up the rest. That's a powerful statistic. Why is relative strength such a dominant factor in performance? And how does that finding guide your top-down investment process?
I think there's still, at least in academia, still a lot of debate about why relative strength works. There are some, another gentleman who won a Nobel Prize named Eugene Fama for kind of an efficient markets theory, and he and his co-author Ken French have a database. Ken French maintains this at Dartmouth, and it's public. You can go on it and look at it, and it has factors like size and value and so forth,
Moment.
and relative strength. And they don't like to talk about it. They're value investors, but even on their own database, relative strength outperforms all the other factors. So it's not clear why. I think I suspect a lot of it has to do with investor underreaction and overreaction. It takes a long time for things to be incorporated into the price. And clearly at the end of trends, there's also some piling on effect. But regardless of the explanation, quantitatively it works. And one of the big problems in this industry is people gather data, make decision rules, and then when they don't work a couple of times, they abandon them immediately. And if you stay with it, and because you can see quantitatively it works over time, it can really pay off. So I think a lot of it has to do with the discipline to use it as well.
Yeah.
In an article you wrote, you make a clear distinction between relative strength and what academics rediscovered and named as momentum. You note that momentum had acquired a bad name bringing to mind a fast-trading gunslinger. Could you dispel that myth for us and explain why a disciplined, systematic relative strength strategy is far more sophisticated than what many people think of as a momentum investing?
Well, I think the idea that momentum is fast turnover really just depends on people's time frame, but a lot of traders that identify themselves as momentum traders are quick in and out. And I think from a relative strength standpoint, which is what it was originally called, 100 years ago, before academics thought they discovered it in the 1990s. Even there, the formation periods that they found useful were 6 months, 9 months, 12 months, longer term type of stuff. And as a result, if you build portfolios on that longer term momentum, even the way academics do it, those outperform. It's a very flexible tool. In other words, if you're actually using a method that gets at the signal and ignores the noise, it performs well over time in a lot of changing environments because it's adaptive. And as we know, things change, and so having a method that's adaptive is pretty critical because you're not always in the same kind of market.
Market is dynamic,
Yeah, exactly.
Yeah. Mike, you are the author of a brilliant piece, as Flávio said before, the 10 ways to sabotage your portfolio. I love your third point. Be afraid to buy strong stocks as a way to avoid the big long-term winners. So what is the psychological trap that makes investors so hesitant to buy a stock that has already gone up, even when it's a clear market leader? You have the trend telling you that it's going to still going up.
Yeah, I'm not sure what that is, but I had a guy who worked in my office, and he would look at these high relative strength stocks that were breaking out to new highs, and he would say, "Oh, that's a lot of risk." And I would say that's a lot of power, right? So it's just a difference in perspective. But when you look at the results, buying things that are down and out over time doesn't work. Buying things that are strong and holding them as long as they stay strong works. I mean, there are times, you occasionally feel stupid because you buy something strong and, 3 weeks you bought it, it gets weak and you have to sell it. But very often you buy things, they stay strong for sometimes a decade, sometimes 15 years. And so those kinds of things have a real ability to have an enormous impact on the portfolio when they go and go and go and go.
Yeah, I can tell you right now, for example, the gold, it's going up and going up, and a lot of people just, is it time to sell? And they say, what are you doing? So yeah, and another great piece that you wrote, the view from the coast. You compared stocks to used cars, noting that a Mercedes, for example, has a great resale value, while a Yugo is just scrap metal. You argued that understanding these concepts of resale value is a key to make money in the stock markets. In getting to our reality, what are the key technical characteristics you look to identify a Mercedes caliber stock, one that investors will want to buy from you later at a higher price? So
Sure. I mean, I think if you keep in mind when that was written, I think Tom Dorsey included in a book that came out in 2001. So during the 1999-2000 run, right, there were all kinds of stocks that had tremendous relative strength. But also many of them, you know, had a post office box and no earnings and no revenues. And, you know, that kind of thing, if something goes wrong, is not going to survive. So I think having some kind of fundamental strength, you know, a real product, real revenues, real earnings, those are the kinds of things that typically continue on for a decade, and don't flame out. So there's some value to fundamental analysis in that respect. I wouldn't ever listen to their rankings on a stock, but you know, generally having something that's a real company and is really working. I mean, in classic economics, right? Profit is a signal that people want your product.
Yes.
Like if you can't actually make money doing it, maybe it's really not going to last.
Very, very true. Another thing, you emphasized that your work is 100% objective and systematic. This contrasts with a common critic of point and figure graphics that is too subjective. And that is an incomplete tool because it filters out data like volume and time. Could you tell us about the importance of a purely systematic process and explain why filtering that noise is a strength rather than a weakness?
Well, I think, first of all, point and figure is probably the most objective kind of chart you can have, because either it's on a breakout or a breakdown, and when you look at that chart, any analyst who looks at it can say it's that. When you're looking at other kinds of patterns, sometimes maybe on a bar chart, you're like, well, is that a cup and handle? Is it I don't know. People don't agree. What wave is it in? No one agrees. You know, everyone has some different count, and, you know, it's about to break out. It's about to break down. I don't know. But with a point figure chart, it's pretty clear. And so from the perspective of, you know, if you look at a company, is it on a relative strength buy, you know, breakout against the market or not? Is it on a relative strength breakout against its sector or not? Right? Is it currently on a breakout or breakdown? Is the trend up or not? You know, all those things can be objectively defined. And if you buy the things that are strong and stay with them until they get weak, then you have a purely systematic method. So you need a method for identifying strength, you need a method for entry, you need a method for exit, and that's really all it takes. And after that, it's honestly, the biggest failures are not in identifying any of that stuff, it's in the implementation and execution.
A Trader Brasil comemora 25 anos e quem ganha é você. Fomos eleitos por 2 vezes pela Rank Awards em 2024 e 2025 como o melhor divulgador financeiro e a melhor academia de formação de investidores do Brasil. E hoje temos um presente para os inscritos do canal. 10% de desconto em nossos cursos usando o QR Code que está na tela. E não se esqueça, é muito importante que você nos siga nas redes sociais. Curta, comente e compartilhe.
Beyond that, you have generally prepared a couple of charts on Amphenol and the S&P Equal Weight ETF. I personally use relative strength for sectors and have never used point and figure on relative strength charts. So I want to explore you a bit. Could you walk us through them and explain how to use point and figure relative strength charts? Okay, I will show you now. You wanted the the Amphenol chart first, or the relative strength?
Let's look at the relative strength chart first, because that's kind of the base thing to look at.
And this is the relative strength. So relative strength, for the audience understand better, it's anything you want to compare, dividing by another thing. Normally a benchmark. That's it.
Right. And this is Amphenol divided by the equal weight S&P 500. So sort of how it's doing relative to the unweighted index. That eliminates all the distortions from the capitalization weighting. Essentially, what let's see, would look like maybe 2020. You can see there's a breakout above the previous two columns, and we would call that, often you'll see it as a relative strength buy signal.
Here.
Right there, correct. And it doesn't mean mechanically buy everything that breaks out, but it gives you an idea that the supply and demand relative to the S&P has changed, and it's now stronger. And you can see that during those entire last 5 years, it has never broken down below a column of O's. So it's moved
We
back
have
and
another
forth.
buy here on 24 here.
Another breakout, correct. But yet another breakout more recently.
Here. Yeah.
Yes.
Mhm.
And so, what you've got is really a breakout, a period of consolidation, another breakout, another consolidation, another breakout. And it just keeps getting stronger relative to the market. And that's typical. We found when we did, I did a paper with Harold Parker just on the 30 Dow stocks over time. And those signals on average last a couple of years. So it's not a high turnover sort of thing. And there are some stocks that wash back and forth between buy and sell on a relative strength chart. But there are many that have long-term buy signals like this one, which you can see here has been more than 5 years. And the relative performance over that time, when you go back and look at the individual price chart that you had earlier,
Here.
5 years performance.
It's like 14, 15, something like this.
Yeah. And now that price per share is much higher.
120.
Yeah. So almost 10x, right?
Yeah. That's
Yeah.
it.
So it's been a tremendous return, and all you really had to do was sit with it through the declines, because during those declines, typically the market was declining more than the stock was on the relative strength chart.
Don Dorsey had a great quote: "The professional will do what the average will not do on a consistent basis." You mentioned this is a good segue in the difference between professionals and amateurs. In your experience, what's the key consistent action that separates the two, professional from the amateurs?
I think the main thing is discipline, and in my experience, that almost always results. It's almost always sell discipline. I think amateurs, if something goes down that they like, that they bought, they're unwilling or ungrudgingly sell it because they don't want to take a loss. The professional cuts it immediately when it violates whatever guidelines they set up for it. And it's especially the case if something has done really well for a long time. Individual customers, at least in the US, are like, well, I don't want to sell it. It's going to be a big, capital gains, tax bill, blah, blah, blah. And I can remember people making excuses for why they don't want to sell General Electric, or why they don't want to sell Nike, or why they don't want to sell, but those things murder you. They absolutely murder you when you have a 15-fold profit and you let it go back into the toilet. It's just horrible.
Yeah.
Amateurs do that all the time. They round trip stuff, right?
I can tell you it's not just in the US. I think in Brazil,
no.
we have also the
No.
same thing.
Of course.
Yeah, it's a human thing, right? But customers hate it. I think it's a lot easier being a mutual fund manager because they're not seeing how the sausage is made. They're the net asset value. But when you run individual equities, they're like, man, you're wrong a lot. You're like, yes, I am, but I'm not wrong for very long. I'm not going to stay wrong.
This is crazy. Finally, you've seen methodologies and markets evolve for decades. For the new generation of traders and advisors today, surrounded by social media noise and algorithms, what's the most timeless piece of advice you can offer for building a long and successful career in financial markets?
It's a good question, but I think the bottom line, like you talked about with social media and all the new stuff coming up, the important point is to try to trade the signal and not the noise, because there's increasing amounts of noise from all kinds of stuff. And like you said about gold, there's, gold was overpriced at 1,500, right?
Yes.
2,000 and then 2,500. I mean, you just have to tune that out. If you can see with your own eyes that the signal is it's going higher, believe it and ignore the noise. One of the most interesting things we did at the broker institutes that Dorsey Wright used to run, maybe they still do this, I don't know. We would have a whole section of the book that involved a bunch of stock charts, unlabeled, only with their industry, and we would have some market charts, some market indicator charts to give them a sense of, okay, here's a point in the market, here's what the indicators are, here's what the sector indicators are, here are the stock charts. Which ones do you want to buy? Which ones do you want to avoid? Which ones do you, okay. Then we jump forward 3 months. Okay, here's what the market indicators look like now. Here's, you have the stocks you own. Here's what they look like. Here's what the rest of the universe that you didn't own looks like. Here's what the sectors look like. What do you want to do now? And they would make their portfolio adjustments.
Oh.
And these were all real charts. They just didn't know what time frame. And they weren't labeled, so they couldn't say, oh, that's IBM, that's a good company, or that's a bad company. All they had was the chart.
So no bias.
No bias. And so we would put them in groups of 6 at a table, and they would each make their decisions, and then we would tally up their results at the end. And over at least the 10 or 15 years we did it, in live groups, and we changed the scenarios periodically. It wasn't the same thing all the time. We had one group out of, I don't know, hundreds that ever underperformed the market. And then they would look at the end, we would show them what the companies were. And they would go, oh, that was it. I would never buy that. Well, that's the point. You would never buy that. But if you look at the chart, you should be buying that. There's a lot of bias that we have in our own thinking that makes us discount certain ideas. When you took away all of those potentially biasing factors, people made perfectly good decisions based on the data in front of them, but they won't do it in real life. And so you need to, like I said, pay attention to the signal, not the noise.
Yeah.
Take all that stuff out.
So this is when the professionals get better than the amateurs, as Flavio said before.
Well,
Right.
I mean, you look at, like, institutional performance isn't always that good.
No. Yeah.
We managed at
That's
Dorsey
true.
Wright briefly, maybe they still do, I don't know. A fund for a bank in Malaysia.
Hmm.
And it was a case where we really had nothing to go on. I mean, except the chart. Like, I don't know what any of these Malaysian companies do, right? Can't even pronounce the names of them. So we're basing it purely on these relative strength measurements. And I think after 2 years, we were the #1 performing bank fund in Malaysia.
Oh.
And they're like, who are these guys? And we're like, we don't even know what companies we're buying. So in effect, our lack of bias really helped. You know?
Yeah. Funny story.
Mike, do you have any books you could recommend on this? Psychology mixed with investing.
Oh gosh, there are so many. I'd have to really think about putting together a list for you. But as you know, there are a lot of good books on trading. There are a lot of good books on investing. There are some good books on point and figure. Tom Dorsey's obviously, but a number of other really good ones. And I think it's not typically the lack of knowledge that's people's problem. It's implementation and the discipline to do it. And I think someone, maybe it was you, Flavio, I don't know, but someone did an interview with one of my co-workers, John Lewis, for one of the CMT podcasts. And he mentioned, maybe I traumatized him. He mentioned that, I used to harp on the implementation, and that's really the key to it, is not getting weak in the knees when you need to buy things, and not dithering and making excuses when you need to sell things. If you're just objective about it, it works fine. And I'm sure lots of methods are like that.
Mhm.
It's almost always the human part that causes people to mess up.
Mike, your insights are a gift to our entire community. Thank you for immense contribution to the field and for sharing your time with us today. It's been a true privilege. Do you have any social media that people could find you, or follow you, or your website? People could be a client of you?
There's a website, I'm sure you can find me, but no, I try not to have any social media.
No TikTok?
It's mostly been, clients have been friends and family the last 10 years. Dorsey Wright was sold to NASDAQ. They still operate, obviously. They still have a great track record. They're still using the same models we built many years ago. I think just recently they put out their 20-year results. They're very good. So it's a testament to a firm that uses nothing but technical analysis to have very good 20-year results. We've obviously had a lot of crazy markets in the last 20 years. And it adapts. And that's the important part.
Oh, thank you, Mike, for being here with us. Thank you. So, folks, that's all the time we have for today on Traders of the World. A huge thank you again to Mike Moody and to my co-host, Vascaíno, Lucas Claro. Say ciao,
Thank you.
Lucas.
Thank you for this great conversation, Flavio. It's been a pleasure to be here. And Mike, thanks for the insights and all the experience you shared with us. So again, Flavio, thank you, and see you guys.
Okay.
Thank you. It's
Until
nice
next-
to meet you as well, Lucas.
Okay. Until next time, trade with discipline, stay patient, and let price be your guide. Take care. Bye-bye.